Right now is a pretty scary time to be an investor, unless of course you know a few strategies to help you make money during a market crash. Let's talk about it. Hi y'all, my name is Greg and I make videos about the stock market and options trading. Today I'm going to be giving you 5 different option strategies to help you turn a profit during a market crash. So to break this video down for you, first I'm going to go over the strategies themselves and the basics behind them, followed up by a little mini example for each of them. And then finally I'm going to give you the risks and the profits that you can make using these different strategies. But before we get into it, if you enjoy this type of video and you want me to make more option tutorials, I'd appreciate it if you leave a like down below and subscribe if you're new to the channel. With that out of the way, let's get into the strategies. Now this one might seem super obvious. Put options. Puts are one of the best ways to make a quick buck off of the market crashing, just like how calls are great whenever you're in a bull market. Now puts are super basic. You're betting on the stock going down by a specific amount in a certain amount of time. So if I were to open a put option on XYZ at a $10 strike price, I'm expecting XYZ to be below $10 by next week. Now this all seems super simple, I know, but I can tell you this, it's going to be a whole lot harder to make money on a put option in a bear market than it is to make money on a call option in a bull market. And this is because it's all about timing the market. And before we get into that and the risks that are associated with this and the profits you can make on put options, let's get into a little mini example. Over the past month or so, the market has come down pretty dang hard and my account's down 15%. So a few weeks ago, I decided to hedge my bets and I opened a put option on a stock that I thought was overvalued, which was BNGO. And I first bought this put on February 11th for $130. This was a $9 put option expiring on March 19th, and I sold this just the other day, a couple weeks later, for $177. So a $47 profit, which isn't a whole lot, but that's mostly because I held this option open for 2 weeks. So while BNGO was going up in the meantime, this option was losing a whole lot of money on that, as well as time decay. If Bionanogenomics were to have fallen 35% the day after, I probably would have made it a whole lot more. I probably would have doubled my money from $130 to $260. But instead, I made about $47. And I opened another one the other day for $360. I turned that into $390. And this was about a 10 or 15 minute trade. Made about 10%, and I exited as quickly as I could. And that's the important thing to know whenever it comes to put options, knowing when to exit your trade and when to take profit, or when to take a loss if you're wrong. Now it's impossible to tell which direction the markets might go, but generally if you think that a stock is overvalued, it's best to buy a put option on that stock, and hopefully within the amount of time that you've given yourself by expiration, the stock will be below your strike price and you'll be able to take a profit before the expiration date actually comes. But do keep in mind, if you don't time this right, you could lose out on everything. So if I were to hold this BNGO put until expiration on April 16th, and it was anything above $12, this $360 that I paid for this option would be absolutely worthless. Another way that you can make a quick buck whenever the markets are crashing are UVXY calls and inverse calls. UVXY is a volatility index that follows the VIX and it has a 1.5x leverage. This means for every 1% gain or loss that the VIX sees, UVXY sees 1.5%. There's also time decay that needs to be taken into account because UVXY gets its leverage from using options. And the same thing goes for inverse indexes like SQs or SDOW. These two are triple leverage inverse indices that follow the NASDAQ and the Dow Jones. This means for every 1% that the markets go down, SQs and SDOW go up 3%. Now this is extremely dangerous, but high risk comes with high reward if you're right. For instance, I bought a UVXY call just a few weeks ago, and only after a couple days, this UVXY call climbed by 200%. Let's go look into it. I paid $150 for these two options, but the first one I bought was for $136. This was on January 25th, and just within 4 days, this more than doubled in price. I bought this for $135 and it was going for $365. Right now, it's only going for $57 though. So looking back on this, I definitely should have taken profit back then, and that's the risk that comes along with buying call options on UVXY. Since not only are you getting hammered by the time decay of UVXY itself, but also the time decay of the options that you're holding. I'm still going to be holding these call option, and my best bet right now would probably be to roll this over to a new expiration date of maybe April, somewhere around there, or May. And I think that this maybe could print another 200% return if I'm right about the timing again. If you want to protect yourself from theta eating your lunch money, it's best to go with spreads. And this is because whenever you short an option and you buy an option, the theta on your short option is going to cancel out some of the theta on your long option. There's a ton of different spread strategies that you can use during a bear market, but we're going to talk about two. We're going to talk about the call credit spread, and we're going to talk about the put debit spread. We're going to talk about the put debit spread first. A put debit spread is similar to a plain put in a lot of ways, but the difference is you're going to put a whole lot less money down and the amount of profits that you can make is limited. With a regular put option, your gains are pretty much infinite, but with a put debit spread, your gains are capped by the difference between the two strike prices you choose. A good example for this right now might be Tesla, because Tesla's been falling over the past couple of weeks, and if you think it's going to continue to fall, put debit spreads are going to be a whole lot cheaper than buying a regular put for Tesla stock. Looking at their option chain, if I think that Tesla is going to be below about $730 by March 19th, I'm going to start by selling an option at the $730 strike price, and then we're going to buy back an option at the $735 strike price. Whenever I open this option, my assumption is that Tesla is going to be below $730 by March 19th. For these options, I'm going to pay $365, and my max potential of profit is $135, which can be calculated by taking the difference between these two strike prices, which is $5, and subtracting the cost, which is $365. So again, if I'm right, I'll make $135 from these options. But if I happen to be wrong on this and Tesla is above $735 at expiration date, which is my top strike price, I'm going to lose the full $365 that I put down on this trade. On the other hand, if I want to make money on people being wrong on their call options, I'm going to open up call credit spreads. Call credit spreads are a great way to turn a profit during a market crash, but they're going to be a whole lot more expensive than regular put debit spreads. With a call credit spread, since you're on the receiving end of the money, you get paid whatever the buyer is willing to pay you. And you have to put down collateral, which is equal to the difference between the two strike prices. So if I have a $5 spread on an option, I have to put down $500 as my collateral. We're going to use Tesla here as an example again, just for simplicity's sake. Our assumption earlier for our put debit spread was that Tesla would be below $730, and we were paying to buy these options. But with a credit spread, we're going to get paid to open these. So we're going to sell to open the $730 call option. We're going to buy to open the $735 call option, and for this we're going to receive $93 of credit. And to put on this trade, we're going to put down $500 as our collateral, and if this trade goes against us, we can calculate our max potential for loss if Tesla is above $735, our top strike price, by taking the collateral that we put down, $500, and subtracting $93. So our potential for loss on this trade is $407, and our max potential for profit if Tesla is below $730 by our expiration date is $93, which is the credit that we received up front. Now, of course, I could close these options anytime I want before expiration. So for instance, if I realize maybe 50% of my credit, or like $45 or so, and I still have weeks until expiration, it would probably be in my best interest, since Tesla is so volatile, to take my profits then, just in case Tesla decides to turn around. And this also applies to the last strategy I want to talk about, which is the wheel. If you've piled up enough cash to afford 100 shares of a stock like I did over the past 6 weeks, or if you have 100 shares of a single stock, you can use the wheel strategy. The way the wheel strategy works is by first selling a put option. And whenever you sell to open a put option and you have the money to pay for 100 shares of the stock, you're agreeing to buy 100 shares at the strike price that you sell your option for. I first bought 100 shares of Workhorse last summer whenever they were trading at around $16 by selling a $16 put option, and I ended up getting filled on this since at expiration, Workhorse was trading for around $15.50. So I've been holding 100 shares that I bought for $16, and with this 100 shares, I've been able to sell covered calls. And this is the second half of the wheel strategy. Whenever I sell call options against my 100 shares, I'm agreeing to sell these 100 shares at the strike price that I sell. Just in the last week, I've done this twice since Workhorse has been so volatile after the USPS contract falling through on them. and I made $250. And just to show you how much money I've made on these covered calls, we'll go over my history on Workhorse. Just in the last week, I've sold one call option for $225 on February 23rd. I bought it back the next day for $120, and then I sold this call option for $300 and I bought it back for $165. So that's $135 plus $105, which is $240 just within the last week from selling covered calls on Workhorse. And if I want to do this again, if Workhorse just flies up for some reason, I'm going to sell another call option for whatever strike price I think would be reasonable, and I'll set my expiration date to something like March 19th so I get a little extra premium from the time value. Right now, these options are pretty cheap since Workhorse was down 15%, but if it were to fly up to something like $18, $19, that'd be a huge gain, and these call options would be going for a whole lot more. They'd probably be more than double the price of where they're at right now. So if I were to sell this $17 call option on Workhorse, I'd be paid $244 for this, and I'm locking 100 shares up as collateral against this trade, and I'm agreeing to sell 100 shares of Workhorse if it's above $17. Of course, I can close out of this option anytime I want, just like I've done over the past week, where I was able to take profits the very next day. So if Workhorse were to fall by another 15% or so, down to like $14 or something like that, I'd probably be able to take half my profits, or $122, just within a single day. And that's usually the best thing to do whenever it comes to bearish options trades, because really the markets can make a U-turn at any minute. And that's the best thing to know whenever it comes to a market crash, knowing when to take profits. It's always best to take profits early rather than watching the market turn around and taking a big L. And that pretty much wraps up the best option strategies to use during a market crash. If you think I missed any, leave it down in the comments below. And before I go, I want to say thank you to all my patrons for their support. And if you want to join my patron list, I'll have a link down in the description below where you'll get access to live Q&A and trading sessions each week, price analyses for the stocks that I'm watching, and also I'll help you with some price analysis on the stocks you're interested in. Thanks for making it all the way to the end of this video, and as always, remember to stay positive, stay green. I'll catch you in the next one. Bye guys.